Barclays Africa says it's clamping down on credit losses. The bank, out with its first half financial results today, reported that credit impairments were down 1%. Its diluted headline earnings per share were up 11% at 797 cents. So with revenues up 6% at 32.4 billion rand. Well, shareholders have been rewarded a 450-cent dividend, and that figure's up by 13% on the previous period. The bank says it's seen positive growth in its retail banking business, its corporate and investment business, as well as its wealth management division. It says it's on track to delivering on its three-year growth strategy, which was implemented in March last year. Well, our reporter Nompu Siziba is at the Barclays Africa's presentation at the Sandton headquarters with CEO Maria Ramos. Nompu, thanks indeed for talking to us. It appears that the strategy by Barclays is working.
Yes, thanks very much, Devon. It does seem as though the three-year strategy is working. And to tell me more about it, well, as you said, I have Maria Ramos with me, the CEO of Barclays Africa. Maria, if you could just come forward. Thank you very much for joining us. Maria, I see that growth in South Africa remains fairly pedestrian relative to the rest of Africa. Just tell us the story behind the numbers.
Well, thanks. It's great to be here. You know, our numbers are really good, and we're exactly where we wanted to be halfway through our three-year strategy. Headline earnings are up 11%. Our return on equity is at 16.4%. Our retail and business bank has performed exceedingly well, 17% headline earnings up. In South Africa, we've got customer numbers up almost 500,000, and that's really, really important for us. And actually, the month of June was our strongest month in terms of our home loans production. So we had a fantastically strong month, and the trajectory is expected to continue in that space. So yes, growth in South Africa looks a lot more muted than in the rest of Africa, but that was always going to be the case. The South African economy is more mature and is growing slower, and outside of South Africa, you know, our portfolio is in economies that are growing faster, and we're investing both in South Africa and outside of South Africa for strong growth.
Now, we see that you seem to be getting a handle on your credit impairments, those coming down, and your non-performing loans. But how do you think you're going to manage as interest rates rise and we're having lots of job losses as well as consumers being under pressure? How are you going to maintain the momentum there?
Well, you'll remember that 3 years ago, or probably a little bit longer now, but 3 years ago, we took an early decision to be really cautious in the way we were lending. And that's particularly in our what's called our unsecured portfolios, and within that, our personal loan portfolios. So our approach in personal lending has been to our own customers, and you've seen our market share in personal loans coming down quite significantly. That remains our approach, and you can see that in terms of what's happened to our credit impairments. In our home loan book, we've been one of the banks in this market that has held to loan to values more conservatively probably than the rest of the market. We are doing 100% loan to values, but only to a specific part of the market where we believe that the customer can really afford to and can repay and can maintain that affordability once interest rates start moving up. But we've been quite conservative, and we've taken an approach that says, you know, how is the customer going to be able to deal with this going forward? Some of that is now beginning to reflect in the performance of our books. We've also invested in our collections capability within the bank, and so we're starting to see that, and I believe that we've got the right business, the right momentum into a rising interest rate cycle. That doesn't mean to say that there aren't going to be challenges. There of course will be, but I think we've done the right thing over a number of years now.
And very briefly, Maria, where do you see the growth? You want to boost your return on equity. Where's the growth coming?
Well, the growth is going to continue to come from our business in South Africa. Our retail and business banking is accelerating. As I said earlier, in that home loan space, we continue to write good business. In our personal lending space, our credit card business is a strong business, and we expect that to continue growing well. Our corporate banking in South Africa has done really well. As you can see from these numbers, we saw strong growth in earnings in our corporate banking business in South Africa, and that's around 30%, and that's expected to continue. Outside of South Africa, we're investing for growth, and we had said that at the beginning of the year in the retail and banking business outside South Africa, we make investments into digital innovation, in our branch network. We're doing that in South Africa, and outside South Africa, the corporate business outside South Africa is also a business for growth. And then our wealth investment management and insurance business, we've seen really strong growth outside South Africa, and that will continue. And those are big opportunities for us.
Thanks very much, Maria. We've run out of time. So much more to ask you, though. Devon, that was Maria Ramos, CEO of Barclays Africa. As you can hear, she's very optimistic about the future. She says that they're on the right track to fulfilling the goals of their 3-year strategy.